Hey guys, welcome to another episode of the short series of the Boom Traders educational videos. So today we're gonna talk about compounding, and I really want to take the moment to go over some math with you. Basically, the key point of the video will be to contrast how volatility is really the enemy in your performance and patience is key in trading. So let's jump right into it. So let's say we have a hypothetical target of 100%. That's how much we want to make on our money from day zero to the end of the year. So if you start your year with 100K or 10K or whatever you start with, doesn't really matter. At the end of the year, you want to double that. That's what 100% means. Usually that's kind of my target. I want to do triple digits every year. 100% is kind of the bare minimum. This seems reasonable, especially with interest rates being lower in the bank within the single digit region. So just to take off our two characters from last episode, Alex and Bob, the two traders we have their different trading styles, and Alec allows for small wins compared to Bob, but Alec relies on an edge of having smaller losses. Remember the first video about choosing your edge? So this is the guy, this is his trading methodology. Bob, on the other hand, is kind of the home run boy. He does the slam dunks, but also experiences large volatilities in his performance and in his P&L. And now it's for us to assess which guy is better suited. It could be personality-wise, or it could be what the market's giving us, and which kind of trading style we want to follow. So if we look at the Alex's performance, we're taking hypothetical 6 months period. This is actually real performance. It's my performance a few years back. And first month, Alex makes 20% over his initial 100K. The next month, he makes 30% over the initial 100K. And then on, he kind of, after month 2, he kind of really tones down his game and has about 4 months of 10 to 5%, which is pretty much, being very patient, being very outside of the market. If we combine all those numbers, we get a cumulative return of 75%, which is below target, right? Since we said at the beginning of the video, the target will be 100%. But there's a catch, so wait until the end to see what we're gonna have. On the other hand, we have Bob, the gunslinging guy, the gunslinging trader. He started off the year with a small drawdown of 25% over his 100K, so that's 25K or 2,500 depending on your account size, just to make the math easier. But from then on, he has 2 stellar months. One, he makes 100% over what's left. So if we say that he lost 25K, he has 75K, he makes another 75 in month 2, and then on top of that, another 50%. From then on, he has a few months of kind of back and forth. He loses 25%, gains 25, and loses 25 again. Net zero, he makes cumulative return of 100%, so he seems to be on target. So if I ask you which trader did better, you probably go for Bob. You probably want to trade like Bob, and that will be kind of what you lean towards. But if we whack in compounding, which is the idea of this lesson, the story becomes a bit different. So now we're gonna take all those monthly gains or performance that Bob has, and we're gonna compound them on top of each other. So when you lose 25%, we're gonna put 100% on top of that loss, then 50% on top of that, and so on and so on and so on. Just bear in mind from the beginning, the way that we kind of put the numbers, or like the way we have sequenced the numbers, the returns, it doesn't matter at all. So if we put 100% at the beginning and we have the 3 losing months afterwards and so on, that doesn't matter because we're compounding. So the math works exactly the same. So let's check out what happens. We start off with the first month whereby he loses 25%. The second month, when he gains 100%, actually compounded wise from his initial starting point, that takes him only about 50% of his initial starting point, which was here at day 0. Then the third month, when he makes another 50% compounded, that takes him to 125% over the initial starting point. And from then on, the losing in the back and forth month, when we've compounded that performance, we see that he actually finishes the month on only 58% up since when he started. So if we take this performance and compound it, his 100k would only result into 158k by the end of the year, which is not bad, but it's not what our target was. So we shouldn't be happy with this. Bear in mind, this system includes 2 months of back-to-back of amazing results. So getting 100% in 1 month and 50% in another, it's pretty tough, so to say, especially in the current environment. Now, as I said, his compounded return is 58%. Now, if we look at Alex's performance, now this tells a different story. We have the 20% which he starts with, and then his second month whereby he makes 30%, this goes to 56. And from then on, we have 4 months of very small gains. However, his small gains actually compound to a hefty 100% win. And his compounded return is 100%. Yeah, I know you would say Alex doesn't have any losing month, but this is, remember, this is only 6 months into the year against 12-month period which you can trade. You can shuffle the numbers as much as you want and nothing will change. The numbers come out exactly the same. This is math. So what our key takeaways will be for this would be that as you put in decent returns, you get kind of hefty, so what our key takeaways of this would be that as you put in decent returns, you get pitches coming your way. It gets progressively easier in order to make the bigger returns. So the plan is to make as much as possible when the opportunity is there and to maximize this opportunity. But afterwards, do nothing until next opportunity presents. Many of you, with January being a down month, might be experiencing a drawdown in the first month. The importance here is not to let this number get too big. The second thing is that you'd never find a system that benefits from a large swings. Like mathematically, this doesn't exist. You're better off of finding a system that has smaller drawdowns. So this kind of move upwards is better than this kind of move upwards. The second is not optimized for P&L, big P&L returns. And keep in mind that while the market is risky as it is now, being patient is the only protection you can have against swings which kind of mess up the math. My most important takeaway that I would love to share with you is not to get into the big trouble. If you're flat, as we are now in our Discord group, and the market is moving up or even making new all-time highs, this is not a problem. There are tons and tons and tons of opportunities, and I promise you there will be times when you can get aggressive. The real problem is if you're trying to do it now, you run the probability of getting into deep trouble and get into the big drawdowns, which apart from destroying your capital, which is kind of your number one job to preserve, it also destroys your mindset and performance. And these are the things, the big drawdowns, which kind of destroy mindset and performance. These are the things that are going to make you quit one day if things don't work out. So in a nutshell, that's about it for the lesson. Thank you very much for watching it. Hope it was informative. If you'd like to see anything specific or want to request some lessons, join our Discord channel. There's a space for that. I would love to kind of work with you to see where this content goes. I would love to share with you my view on the things. This will be uploaded to the YouTube channel. Subscribe. We do market overviews on a weekly basis there, so you would see how we perceive the market. And we also have Twitter, whereby we share some ideas over there as well. So thank you for watching, guys, and have fun trading.